Hey guys, there's a lot going on in the markets at the moment. So all I will say here is just take a deep breath, ignore the headlines, ignore the rhetoric, don't be influenced by what you see on social media. Instead, you want to be focusing on the technicals and the fundamentals. There's always opportunities when sentiment gets to extremes like this and positioning changes so rapidly. Your job as a trader is just to stay calm, try to identify those opportunities and then place trades at the right position size and manage your risk with a good risk reward. So that's all you're here to do. You can forget all the rest of the noise. Okay, let's dig into the analysis.
Let's have a look. We'll start with the macro picture. So overall, we have loose financial conditions, and loose financial conditions is what we want to see for risk. If there's lots of money in the system, typically it means people use that money to buy risk assets. So let's have a look at this. So we've got money supply. I'll bring that up on the chart here. You can see money supply in the US, we're near the peak. Okay, so loose financial conditions. We have a weaker dollar. So this is the dollar index here. It was up around 109. We're trending down towards the 100 level. It's a pretty big level. So we've got a weaker dollar. Again, good for risk assets. Now, how's the Federal Reserve going to respond? So typically we like it when the Fed is what we call dovish, that is they're cutting interest rates. We don't want them to be hawkish, hiking interest rates. Hiking is restrictive for financial conditions, lowering is good. And the Fed looks at a couple of things in particular. One is inflation and one is payroll data. So we can start by having a look at payroll data. So this is the number of employees in the US. So yeah, I mean, we're trending higher. We have no problems here. So let's say employment currently is strong, give or take. Are tariffs going to impact that? We'll yet to see. Now, the thing though is, if tariffs do start to impact employment, it probably means that we need looser financial conditions. We want financial conditions. If we get a negative shock, then we will probably lose financial conditions. So sort of win-win each way in a sense. And then we can look at inflation. So we have the year-on-year inflation rate, and it's not the lowest, but it's not the highest, and it's trending down. And it's also good to look at trueflation, because trueflation is another measure that will just give us some insight into whether this is likely going to head higher or lower. And if we look at trueflation, over the last year, you can see it's gone from 3%. We're down at 1.4% on the trueflation US inflation index. Okay, so this points to, again, loose financial conditions, because if inflation is higher, that means that it's harder to cut rates. And that's that stagflation scenario that people are scared about. They're scared that inflation is going to be high, growth is low, you get stagflation. And in that situation, the Federal Reserve has a limited ability to actually do much, because if they lower rates, inflation goes up further, which is what they don't want, right? So what we want is a situation where interest rates, where inflation is low, so it's easy to lower rates, and we also want a decent amount of employment, so there's no concerns there. While we're here, we can also look at manufacturing data too. So you can see manufacturing data is around the 50 level, a little bit below. The 50 level is expansion, below 50 is contraction. So we're a little bit weak on the manufacturing side at the moment, but nothing majorly concerning. Now, of course, we have some geopolitical things we need to consider, and that's this ongoing conflict between US and China, or tariffs and all that sort of stuff. And we need to think about that. How's that going to change the fundamentals moving forward? And if tariffs are a negotiation tactic, then things are probably not going to be too negatively impacted moving forward. If things escalate, and particularly if we get some worst case scenario situation, it's going to be really terrible for the fundamentals moving forward if there's some sort of hot war or something. But if it's just part of this power game that's going on, then we may not see too much. And again, if we do see financial conditions worsen, as long as inflation stays low, it means loose monetary policy. That's the key here, because for risk, we want loose monetary policy. We want lots of liquidity in the system. Now, the big thing, obviously, that also drives all this is US debt. And it's important to understand that because of the amount of debt the US has, it has to basically have loose monetary conditions and print money, all that stuff, which is, I'm not saying it's good or bad. I mean, basically, all that stuff actually is more bad than good, because printing money is essentially debasing the currency, debasing the value of everyone's money. So printing money is bad, but irrespective, that's what we've got because of the debt. So that's sort of the macro picture there. And if we just zoom in on the US dollar for a second. In 2017, when Trump first came into power, the US dollar weakened substantially. And it's important to understand here that the Trump administration wants a weaker US dollar. Why do they want a weaker US dollar? Better for competition, it eases financial conditions. That's what they want, it's what they're currently getting at the moment. They want to see that helps them. It's also important to understand that China wants a weaker dollar. And credit to Raoul Pal for this concept or this idea, or bring this to light. China wants a weak US dollar because they have dollar denominated debt. Okay, so if you've got debt and the value of your debt keeps going up, that's bad. If the value of your debt goes down, that's good. So the two major global powers want a weaker US dollar. Okay, now, a couple other things to look at when we think about the dollar. We have, of course, we've got the dollar index. You can see dollar's heading lower, and we can look at bond yields. So bond yields drive currencies. You can see we're starting to trend lower here. This is a weekly chart. Okay, we had this big bounce. This big bounce basically all just happened yesterday, but we're still within this downtrend here. And bonds, you also often want to compare them to bonds of another market that you're trading. So for example, if we look at bonds in Germany, German bonds, you can see the picture here is different. You've got an uptrend in bonds. You've got a downtrend in bonds, which of course results in a downtrend in the US dollar. And remember that the US dollar index is 60 or so percent made up of the euro. Okay, so we've got a bearish dollar. A couple other things just to show you. I've noticed that banks, I read a lot of bank reports, and the bank reports are really good because the banks understand their economy of their country and their currency very well. And they're often conservative, maybe too conservative, but they are pretty good at helping you get the direction right over time. And if we look at Danske Bank, they have just put out a piece saying, we've flipped our view on Euro USD. We're now forecasting it to cross $14 in 6 to 12 months time. We can look at Westpac, and I like looking at Westpac at the forecast. So we've got the exchange rate forecast here, and you can see basically everything they're saying US dollar weaker over the next year or so, or leading into 27, next couple of years. So the forecast from these banks is a weak US dollar. Sort of what everyone's expecting now, wasn't what they were expecting before, and it's what they want, what people want as well. The other thing we want to think about is sentiment. So if we look at the fundamentals at the moment are basically pointing to looser monetary conditions. If we get a tariff shock, I don't think it will massively change things. It could, if it's a negotiation tool, which I think it most likely is, then again, that doesn't change things too much, because everyone wants a weaker dollar, everyone wants looser financial conditions. That benefits them politically and helps them achieve their goals. So we can see here at the moment though, because of the headlines, because of Liberation Day, we have fear and greed at an extreme. So this fear and greed index measures a number of things like momentum, stock price strength, how many stocks are oversold, things like that. We're all at the extreme fear level. And if we think back to one of the fundamentals of trading, is we want to be buying when everyone else is fearful. We want to selling when everyone else is at extreme levels of greed. We want to be doing the opposite. So given the fundamental conditions and given this sentiment, which is really headline-based fear, I think, fear over recession, fear over stagnation, which just don't look like they're going to happen based on the fundamentals. And obviously a lot of this fear is about uncertainty. People weren't expecting the Trump administration to do what they did on Liberation Day. They weren't expecting such hefty tariffs But the thing about this is there now going to be less uncertainty moving forward? That's what we need to be thinking about. And I suspect that in 2 weeks' time, we'll have a clearer picture. Like that, we are at extremes of uncertainty at the moment. And this is, I think, market sell off because of this uncertainty, because of these fears, rapid position adjustments. Hedge funds had to liquidate some of their positions when they're on the wrong side of it. Everything moves quickly. And we've now seen the NASDAQ down around 25% from the high. Let's look at this from an opportunity perspective. So where do the opportunities lie? Well, for me, I'm positioning myself in 3 ways. The first of these is I'm short US dollar. So I think US dollar is going to head lower from here. I'm short from a little bit higher, but you can still be, I think, looking for opportunities, technical opportunities to sell. And we can expect a move down to this low. If we break here, look, there's a lot of space. There's not much support. So if we break the 100 level, we could see a fair extension of this downtrend. All right, so I think short US dollar is opportunity at the moment. Short against what? Short against the euro, short against Japanese yen. We've seen extreme moves on like the Aussie dollar, Kiwi dollar. I think these end up much higher. I mean, the Kiwi looks really nice down here around these levels at support. Obviously contrarian trades, so if you're taking a contrarian position, you always need to manage your risk very well, because if the trend does continue against you, then who knows where you can end up. But these look like the right levels to be going in. I would like to see one more push down on the Kiwi here, one more push down on the Aussie, but otherwise we may see the trend change. And I'll just put the daily chart here, and I'll add an indicator. We'll put on the 200 period, 200-day moving average. Okay, so once we start trending back above the 200 period moving average, I think is good, or otherwise off the support level. So these are sort of the two opportunities. Playing around in the middle here, it will be a bit tricky. So short US dollar, I think, is one opportunity right now. The next thing we'll look at is stocks. So here we've seen this sell off in stocks. And this is the 200 period moving average, so we're well below here. If we look at a weekly chart, you see we've been pulling back towards the 200 week moving average, which incidentally has been a very good place to buy NASDAQ in the past. If we look at the daily chart, we can see that the market is very oversold here. I'll just put the RSI on. We've had this RSI first got oversold here, and then it's failed. I thought we might bounce from here, we didn't. Due to the uncertainty around Liberation Day, and we've sold off, and we're now again RSI reading very bearish. And a lot of the stocks on the index are also similarly oversold. So potential opportunity, and let's remember we're already down 25% from the high. So it's a pretty substantial drop already. We're back up here, so we're currently sitting around 20%. The way I will be looking to trade this is I'll have my weekly chart, and I'll just be looking my entry indicator here. So I'll be looking to buy once we get back up above this level, sort of once my indicator gives me a signal, just indicate that the downtrend is over. The final thing that I think is very interesting at the moment is we have Bitcoin. And so you can see long-term uptrend in Bitcoin, and we had this double top. So it's a pretty significant double top. We saw another double top way back over here, sort of even call that a double top too if you like. Yeah, it has led to these sell-offs previously. I think financially, given current conditions, that we don't get this extended sell-off, we get more of a dip. If we've pulled back towards around the 50 period moving average here. And we're now seeing this double bottom formation. Just to go to the daily charts, I've been trying to buy Bitcoin for a little bit. So I first bought a little bit here, very small, added here, and now we've got this retest of the low, this failed break of the low. Now if in the next day or two we end up back below here, then the picture becomes a little bit more bearish again. But I think buying from around these levels is decent. You've got a nice technical picture, and adding a stop around 72 is probably not a bad idea. 72 gives us a little bit of space to breathe, and we can be targeting for moves back, I think, above and beyond these levels. And who knows where crypto goes if it does go. So I think interesting buying opportunity here. Again, we are in a little bit of a downtrend, so it's not necessarily, there's not necessarily no risk or anything like that. There's risk that comes with this because we're in a sense picking a bottom, but we have a strong level to do that. And this chart lines up with global monetary supply. Again, credit to Rail Powell and his work he does on that. So it sort of lines up very nicely, and that is also indicating that we will see this recovery at this point. So when you've got the fundamentals and the technicals lining up, you've got a nice position like this, you've got this bearish sentiment, so the market is mispositioned compared to perhaps what it should be due to fear, then lining up for a buy opportunity. And for me, that is short dollar, looking to buy, which I've been short for a while, looking to buy NASDAQ on the bounce, and I have a Bitcoin position on at the moment and expecting it to obviously head higher from here with stop at the 72 level.
So I hope you guys enjoyed that. So just remember, there's a lot of noise, there's a lot of rhetoric, it's a very emotionally charged sort of environment at the moment. So your job is just to stay calm, just forget the noise, tune it out, look at what the market is telling you, look at the technicals, look at the fundamentals, and make good trading decisions. Okay, I'll catch you next time.